Let's bring in Trivariate Research's Adam Parker. He's also a CNBC contributor, is out with his 25 outlook this year, but of course used to be a semi-analyst in your prior days. Good to see you. Happy New Year.
Happy New Year, Scott. Good to see you.
You have AI-related semis as a key part of your market story for 2025, don't you?
Yes. And I know you always accuse me of being a little bit biased toward the background in semis, but that's true. I like semis over software right now. And I know a lot of clients are out at CES waiting and hanging on every word, just like Christina just said. So it's a big event. I think Jetson will outline a lot of applications and get people excited again, as he usually does when he goes out and talks to the street.
How do I want to think about mega cap tech this year as we get going?
You know, it's 33% of the market, the S&P 500 technology. So even if you're market weight, it's still the biggest position you have in the portfolio. So I think folks have to think about owning big positions in tech. As you see today, a lot of the semi caps and some of the non-NVIDIA semis had really lagged, and so they're catching up. I think there's other names you can own in semis where the risk reward skewed to the positive, particularly because inventory for a lot of industrials has peaked and is coming down. So I think you want to own the big names, at least in the market weight, and I think you want to own semis where the inventory's peaked.
You know, the market's felt a little wobbly lately. You know, if you look at the price action to end the year and even beginning the new one, maybe we're, trying to right some wrongs here over the course of this week. We'll see what happens. But you suggest more broadly that the equity market is increasingly risky. Those are your words. Why do you think that?
Yeah, and we kind of wrote, we think maybe we're going to be down some in the first half. And, as you and I talk week to week about the upside or the bull case to the market, I sort of felt like when we put, pen to paper, so to speak, in December for this outlook we published today, that a lot of the pillars of the bull case looked less compelling. I mean, margins, I don't think they have quite as much upside. I think there's risk that the CPI could, be troughing or maybe rise in the second half of the year. As we alluded to a couple weeks back when we chatted, I'm not sure people are going to view extra accommodation from the Fed as that bullish. You talked about the 10-year hitting 4.6. So at some point, the interest rate environment's less benign. I'm not sure people are psyched about incremental U.S. spending and that working its way into the big cap tech stocks as much. I don't think people are as psyched about China as maybe they were. So, if you go down some of the bull case, it's less compelling. And I think the last thing is sentiment. A year ago, you could have romanticized on your program your contrarian bull. 2 years ago, you certainly could have, and you can't now. I mean, most of the strategists are out there with 66, 67, 7,000 on the S&P. And so it's not like you can say, I'm the contrarian, bull. So I think it's a little less compelling in the first half of the year when I look at the risk reward.
I can see you on all of that. But what if I say, well, then I'll raise you tax cuts and a friendlier environment for business and deal making and animal spirits and pent up demand and all that stuff that has still a lot of folks thinking that this bull trend is well intact?
Yeah, I think the two most compelling parts of the bull case that resonate with me are definitely the M&A cycle, which I think there'll be a big one. And I think if you do get a 5 or 10% sell-off, that'll probably start you see more deals. You could see that as the floor in certain industries. And definitely, I think AI productivity, where you're going to get some companies telling you their earnings are improving or they're not going to hire like they would have in the past. Those are definitely bull case things I believe in. In terms of your animal spirits thing, I think there's offsetting points now, meaning out of the gate, we were together on election night. There was definitely a benign interpretation about all the policies. I think now the dollar strengthened a lot. There's some of the policies may not be quite as bullish for the fundamentals of the company. Some CEOs might be a little bit more cautious about how to optimize their employee mix, U.S. versus non-U.S. So I think you got that initial positive interpretation, and now I'm looking for where will I see a fundamental support, and so I think it's more balanced on that on the kind of animal spirit side. It's really just M&A that I still think will be big.
What if the tariff teeth, so to speak, are not as sharp as we once expected that they might be, at least out of the gates?
My view, and this could be wrong, but when I talk to institutional investors, I think people, and that's part of why I said benign interpretation, I don't think people are embedding that in the prices of the stocks. I mean, the only policy that I think is in the stocks has been the healthcare price action, where everyone just assumes the incoming, policies from RFK Jr. will impact the earnings of the healthcare companies. That's why they've had the worst kind of 2-year relative performance in 25 years. Interestingly, that's in the price, but not in the price, I think, are, the potential for tariffs to raise prices and companies to maybe lose demand as they raise prices, that kind of stuff. So I don't think, even though that banter is out there and it's been regularly reported on, the stock market guys I talk to aren't saying I'm selling those stocks because of it yet. I think they don't believe it'll be as negative as the banter.